Well, good morning, everyone. This is Bruce Fleet of Fleet Capital Management. It is Saturday morning here in Bellingham on the 7th of May. I hope you guys had a good week. I hope you enjoyed Cinco de Mayo as I did. What a wonderful holiday, or I should say excuse, to drink margaritas and eat chips and guac. I have to start with a disclaimer as always. If you are viewing this YouTube video and you are not a client of Fleet Capital Management, please do not consider anything that I review on this video as a recommendation to buy or sell. Recommendations are only given to active clients of Fleet Capital Management. If you'd like to learn a little bit about our firm, first step would be please go to our website at www.fleetcapitalmanagement.com. Lots of good information on the website. Second step is call me, so we can just have a chat and see if there might be a potential relationship there between you and our firm. My direct line at the office is 360-389-6407, or my email is brucefleet that's F-L-E-E-T, brucefleet@gmail.com. There's also a contact me form within the website. So lots of ways to contact me, and we just have discussions to decide if we should move forward. So with that said, welcome to this month's monthly webinar. Let me tell you that this one is going to be very, very technical in nature. So if you're someone who really doesn't want to understand what happens in the kitchen before your food is brought out to the table, this one's not going to work for you. So you may want to just tune off of this one and tune back in next month. But this one, the purpose of this webinar is I want to show you a little bit deeper into the decision-making process, the why we do what we do when we do it, and what the effect is on a portfolio. So this is going to be a little more technical. Consider yourself fair warned. And this was a request from a client to go over this. Next month, I've had another request to review the TD institutional online view that I have for you, and also the web portal view that I've been building and have for you. So I'll probably do that next month. That'll be much lighter and much easier. The way I understand my marching orders as you have given to me, or we have agreed on, is that you have said, Bruce, number one, I want you to protect my money. Protect my money from Black Friday, or Black Monday rather, back in 1987. Protect me from big recessions. The biggest and the most recent we saw 2008 into the beginning of 2009, which was pretty devastating. That took the market down 40 to 50%, depending on the market you're in. Protect me from big bear markets. Protect me from all of those things. To me, I understand my number one marching order is to protect your money. Most of my clients are retired, not all, but most, probably 85% or 80%. And you have told me, look, if we go into a down market, I don't want to lose 20% or 30% or 50% because I have no interest in going back to work to make that money again. Folks, I hear you. So number one is to protect your money. Number two marching order is make me money. The funny thing is, and it's not funny, either one of those two objectives alone is relatively easy. The combination of the two is incredibly complex, and you will see as I go through this decision-making process with you and really show you what we're doing here. So let me clean up this screen just for a moment. Okay, you should be able to see my screen, and this is a chart. We're going to start with a little bit of a long-term look, and then we'll go into shorter-term looks of what's really going on here. Let me grab my handy little annotator button. So I know many of you are a bit tired of hearing me say we're in a sideways market, but I hate to say this, we're in a sideways market, folks. And I'm going to explain to you what that means and also what comes from it. So you should be able to see this rectangle that I've just put around this market. This goes back, this is a weekly chart. So each bar or candle represents an entire week. And this goes back to Thanksgiving of 2014. I think I have sent many of you this chart. And what I want you to see is we had a very, very long, after the 2008 recession, we had a very long multi-year bull market. Very long, very successful multi-year bull market. We were all happy. We all made money. And then it started to go sideways. This is called a consolidation pattern or a mixed signal pattern, in that the market's trying to figure out, should it be going up and resume its bull market trend, which it would have to go through to new highs, or is it time to retrace and go down a bit? We've had a couple of pretty dramatic retracements. The beginning of this year was one. Last August was another, but they did seem to bounce back. But look where they bounced back to. They bounced back right to that level. And this is a consolidating market is normal. To have one this long is a bit abnormal, but we're following a very aggressive, very long bull market. So that gives me an understanding of why this sideways market has lasted so long. Sideways markets, their characteristics are, they drive us absolutely out of our minds. And when I say us, I mean both you and me. Me as the manager trying to figure out, what's the market telling me? Where does it want to go? What's it going to do? What's its next leg? Can I find a new trend? It drives you crazy because the level of where the market was back Thanksgiving 14 and the level of where it is now are pretty much the same. And remember, our second condition or second marching order is make me money. Well, if you're standing at the base of an escalator that is supposed to go up to the next floor and the escalator just isn't moving, you're not going to make a lot of progress going up. So it's really hard to make money in a sideways market. With that said, the longer the consolidation, and this is a long one, in theory and in practice in the past, the more explosive the next phase is. I think the next phase of this market will be up. We may have to go down again before we go up, and I'll show you why. But this could be, if we are patient, which we kind of have to be, we really don't have a choice. The market does what the market does. This could be setting us up for a pretty explosive upside, okay? With that said, now let me move to, bear with me here, let me move to a daily market before we kind of drill down deeper. And I'm going to take you to the Dow, but I want to use the one that I have annotated. There it is. Okay. So this again is the Dow Jones Industrial Average, but this happens to be a daily chart. So each candle represents one day. Here was the beginning of 2016, pretty massive downdraft in the beginning. And then about halfway through February, we started to come back up, and then here we are. A couple things about this chart. Number one, this is not a bull market. This is not a bull market. This is a reactionary bounce, bringing it back to prior levels. In order for it to be a bull market, we would have to go higher than the all-time high and continue above this line. I'm going to explain these two red lines right now. So volume by price resistance, this lower red line, what this part of the chart does is it monitors day by day, actually second by second when the market's open, but it's not open right now, is the day an up day or a down day, and is it big volume or small volume? And if it's a large, we've had a lot of volume, both up and down, at this price level. Okay, so this is volume by price. We've had less volume at these prices. We had some pretty significant volume here, but you can see those were less volume. A tremendous amount of concentrated volume in these prices, right in here. You see that? So if I draw a red line along the tops of those daily closes and bring this out, you can see that's called volume by price resistance. That's the first level of resistance, and you can see the market rallied and went through that, which is very good, but it couldn't sustain it, and it turned it and went back down. Because the next volume, which is more significant than this first level of volume, is all-time high volume. And the reason this is significant is because if the price breaks through that resistance level and can hold, we are then technically in a new bull market. This is not a bull market, but going above and sustaining is a new bull market. It's pretty common, it's very common, for prices to hit a resistance level, bounce down, try again, hit a resistance level, bounce down, try a third or fourth time, and break through. That's normal. We just broke this first level resistance and we couldn't hold it. So it's kind of bearish, but we might try to do it again. So I want you to see that there are two levels of resistance that we have to break through on price before we're in a new bull market. And remember, a consolidation market is a confused market. It does not know yet. It doesn't have conviction of should we be in a new bull market, should we be in a bear market. Also remember that bear markets are fairly short-lived. They're very fast, sometimes just a couple of months. A true bull market usually lasts a couple few years at least. So bull markets are slower to grow your money. Bear markets are rapid in losing money. It's just the nature of the beast. That's how they work. So that's why I'm always trying to protect, because if we go into, and what you don't know is what's going to happen tomorrow, because we live on the right edge of the chart. We look to the left to gain knowledge and insight of what has already happened. We can't look to the right because it hasn't happened yet, which makes this work difficult. But we want to protect. This was a bullish candle, which I'll show you why in a minute. But this market could easily continue back down. Could it test these recent lows? Look at how the consistency of those lows. Yeah, we could. I don't think we will, but we could. Could we go down about half, call it a 50% retracement? We could before we go back up, or we could just start up. We just don't know yet. So if we don't know what's going to happen tomorrow, how do we make decisions as to what to do, what to buy? Do I buy bullish investments to take advantage of that? Do I buy bearish investments to take advantage of that trend? Well, that's what I'm going to show you in this video, is what's the thought process to be able to make a decision. So let me close out of here. Bear with me again 1 second. And what I'm going to do is I'm going to bring over another one of my computers virtually. Nope, that's not the one I wanted to bring over. This is the one I want to bring over. Okay, so you're looking at another computer in my office, but since the video is being done on just one machine, we do it virtually. So I created this. This is what I call a daily trend analysis. And little notes to myself. Trade when the odds are stacked in your favor. And no trigger, no trade. And I'll show you what that means in a minute. And what I've done is I built this, this model, if you will. And what I'm analyzing is the markets first, and then I'll go into stocks. I'm looking at the S&P 500, the Russell 2000, which is more small cap, and the Dow Jones Industrial Average. And what all of these things are on the left-hand column is what I'm going to show you today. So it is going to be technical. This is a trend decider. This is a strength weakness indicator. This is an RMO, Rahul Mohindar oscillator. So I'm going to kind of go through these, and I want to show you, I fill out this sheet every day, and it probably takes an hour early in the morning, and I'll show you a completed one after I show you all of the analysis that gets filled in with this. And I hope you find this interesting. So I'm going to close out of that, and I don't want to close this yet. Hold on here. Let's see here. I want to connect again. All this technology confuses this guy once in a while. So what I'm going to do is close out of that, and I'm going to bring in this. There we go. So here are my technical screens. The first one, and I'm not going to spend a long time because it'll take an hour to do. I'm going to spend a fairly quick amount of time, but I want to show you what I look at every day. And I'm going to blow this up a little bit. This is called a trend indicator. This is part of Rahul's company. Rahul is the designer of some of the technical analysis I use. His company is in India. We converse probably once or twice a day. There's obviously a day lag because when we're awake, they're asleep. There's a 12-hour time difference. So these little notches here, those are all prices, and this is every single day. So forgetting all the lines, these black things are prices, and how did the market do that day? This is volume down here. What was the volume like? And this is an average of the volume. So what I'm looking for here, a bullish phase would be the green is the daily trend decider. What's the daily trend? The week is the weekly trend decider, and the blue is a monthly trend decider because there are short-term indicators, intermediate-term indicators, and long-term indicators, and you're looking for all three. And what I'm looking for here is I would like the green to be above the red, which it is here, because that means in the short term, it's more bullish than even in the intermediate term and the longer term. I'm not going to worry about this long-term part for a minute. And what this is showing me is these prices are running right. Look how long this green line is traveling above the red. It dipped back down, but then it traveled, and it dipped down a little bit, and then it traveled, and then it kind of stopped. Okay, so I'm looking at the daily trend versus the weekly trend. If this green line is below the red, like it crossed here, that's telling me that in the short term there's more weakness. And look how it just beautifully followed it down. Then this was kind of a fake out, and then it went down, and then it started back up. So it's not a predictor, it's an indicator. And those are two different things. So I'm looking at this, and what I'm seeing, this would have been Friday, is that my green is below my red, and that is bearish, but my price closed above the green, so that's called neutral. And we are in a neutral. Let me show you the descriptive here, because anything called an expert advisor just sort of describes what's going on. So looking at this chart, the trend decider, TD, is in a corrective up move. It could come back down, and that would be very bearish. So it's in a neutral state right now. The SWI, which I'll show you in a minute, is in a bearish pulse. That means based on volume, this chart looks bearish. The RMO, which is long-term, is positive. So let's go through a few of these things. I don't know that this will confuse you. I just want you to see what I look at every day. So the trend decider is neutral. So when I'm sitting here on Saturday planning what my trades are going to be on Monday, right now it looks neutral. It's not giving me a left or a right or an up or a down. Let's go to a couple of more views of this. Now, I'm only going to do the S&P 500 for now because it would take way too long to do the others. Here's the SPY. This is looking at volume. Here's my volume. And again, these black lines are the daily prices of the Dow Jones Industrial Average. What the red line is it's looking at volume. Volume is a powerful indicator of market direction, or I should say support of market direction. For instance, when the lines are below the red, it says there is not volume to support an up move. There is volume supporting a down move. So anytime these black bars are below that volume red line, it's saying the volume is supporting a downward move. You can see then it crossed. This was towards the end of February, even though the rally started a little bit sooner, like mid-February. Volume didn't catch up to support it because no rally can continue without volume support. Can't happen. So here, this is like a confirmation, is our prices crossed above the strength weakness line and rode it up. See how interesting that is? But now it has crossed below. So can the market go up without volume support? Yes, but for a very short time. It can't do it long term. It won't have a long trend and have no volume support because volume is like the water that raises the boats up. You have to have volume support for a rally. I guess that analogy could be there could be a little wave that'll raise it up and bring it down. But if the tide comes in, which is the volume, it'll raise it up and it'll maintain. So that's strength weakness. And bear with me, all of this is going to make sense in a couple of minutes. Then I take a look at the counter trend indicator. And on the counter trend indicator, what I'm looking for is if a market is in a downtrend, when I see the first buy in what's called a counter trend indicator, not the second buy or third buy or fourth buy, the first buy after a downtrend, that shows me it's a very early indication that the trend is changing. Here was a downtrend, first buy, no other signals. First sell, but that was a fake out. It wasn't confirmed. So you get a lot of different signals. That's why you look for the first one. Here was a little bit of an uptrend. Here's the first sell, and it worked. So anyway, I look at this because even though the market's going down, I have not gotten a sell counter trend indication on the S&P. I have, in fact, gotten it on the Dow, and I'll show you that in a few minutes. So just one more thing, one more piece of the puzzle, one more clue that I'm looking for. Then what I do, let me close out of this, is I go to Rahul, his main charting system, which is called ATM RMO. And let me put on our expert advisor. And all of these different screens that I'm opening up, they're looking at the market through a different lens. And if I get a consensus, 7 or 8 out of 10 different things I'm looking at are bearish, and 3 of them are bullish, I'm going to err to the side of bearishness, because we're slicing and dicing now. We're looking at the market through a lens that's looking at specific areas of the market. So this is one of his main ones. This is called the RMO ATM. That stands for Rahul Mohindar Oscillator Automatic Trend Model. And what I'm looking at here is if the bars are blue, that's a very bullish consensus. If the bars are red, it's pretty bearish. And then there's light blue, which is kind of a weak bullish, and light orange, which is a weak bearish. It usually goes from red to orange to blue, and then it turned back. So there's 4 different phases, if you will, of this particular system. So right now they're light blue after a fairly long string of dark blue, which means we're losing sentiment. We're losing strength in that upward market. Does it mean we're going to go into a bearish area? No, but it's a wake-up call. It's an indication. And it's based on this, which is the RMO model. And the RMO model, when it's above 0, is bullish. When it's below 0 is bearish. But I can see, even though the RMO, let me find it on here. There you go. No, that's the RMO 2, excuse me. Here it is. Even though the RMO is bullish, above 0, it's falling pretty consistently and pretty dramatically. The minute it crosses below the 0 line, this will turn to bearish. This light blue is just catching my attention to show me we've changed from blue to light blue. It also has something called the breakout catcher, which is a very short term. Remember, there's short, intermediate, and long term. RMO is long term. Okay, ATM breakout catcher is short term, and it's saying it's sensing bearishness. The trend decider is short, medium, and long, but the short term is not short, it's neutral. The volume that we looked at is suggesting bearishness. Don't worry about zone detector right now. And the RMO 2, which is intermediate term, is suggesting bearishness. So all we're doing here is we're like I said, we're slicing the market up into many different aspects of ways that we can measure the market and trying to catch a consensus. And again, bear with me, and I'm going to just show you a couple more things, and then I'll tie it all together. There's another piece of technology that I use that is not from Rahul's company. It's actually from a guy on the East Coast. Let me find it right here. It's called LCI. His name is Logan Connor. His company is LCI Indicators, or Logan Connor's Indicators. And this is what his analysis looks like. And again, it's just another way to look at the market. And what he does is he's got multiple resistance lines. Red is resistance. We've talked about resistance before. Green is support. If it falls, it should bounce off of support. And don't worry about the dashed lines. Those are a different type of an indicator. But you can see that it went right up to his first resistance level and fell back down. Again, he's looking at it using something called Fibonacci retracement levels. Some of you are familiar with Fibonacci, some are not. That's okay. Which is a different way of looking at resistance than the way I showed you previously. But look at what happened. The same thing. It kind of hit resistance and bounced back down. This top resistance is all-time high resistance. So, and then what I'm looking for here is, and I'll show you on the next sheet, where are we in relation to these main resistance lines? And here's the resistance line here. I would say we're kind of at, excuse me, this is support line. I would say we're kind of at support, and I see support as being generally bullish because many times it will bounce off of support and start to head back up towards resistance. Sometimes it'll bounce off resistance, head back down to support until it breaks out one way or another. So he's using, again, Fibonacci. He is saying the trend right now, he's calling it stronger bearish. I'll bet on the day before, let's see what he called it, weaker bearish. Yeah, because it's bouncing around. But it's still, he's seeing a bearish pulse in the market. He's also looking at volume. SWI, we just looked at from Rahul's company, is volume indicator. So is this. Volume is currently below average. And what that means is the current trend momentum is slowing. So that's why it's now weaker bearish instead of full-on bearish. And then he's also looking at something called cycles, and that's done by this oscillator up here. When the oscillator gets towards the top, that says that it's overbought. When it gets to the bottom, it's saying that it's oversold. This is not fully oversold. It could go down lower, but it does look like it's starting to bounce. And again, all of these indicators. So how do I tie, if I still have you with me, how do I tie these indicators together? Well, let me show you. Bear with me. Let me go back to this other computer and make some changes. So remember, we looked at this, and now what I'm going to do is I'm going to fill that in, and I'm going to show you what it looked like Friday when the market closed. Okay, and let's bring that over, connect. Okay, why am I not seeing it? There we go, thank you. So this is what the chart looks like filled out. Let me blow this up for you and drag it over here and see if I can move it. Let's see if I can move this. No, I can't. Unfortunately, I can't move it. So this was on May 6th, which was Friday, and I finished this at 7:45 a.m. That's my finish. Remember, I've got S&P 500, Russell 2000, and Dow. And we looked at the trend decider. We looked at, that was the green and red lines. We looked at the strength weakness, which is the volume indicator. We looked at the longer term RMO. We looked at the midterm ATM2. We looked at the counter trend indicator. We looked at the breakout catcher. So what I fill in is what am I seeing? And the trend decider was bearish for the S&P. It was bearish for the Russell 2000. It was bearish for the Dow. The volume was bearish across the board. The RMO was positive. That's longer term. The ATM2, which is intermediate, was bearish. And it's not always consistent across all three. That's a whole nother discussion. But this time it just happens to be. In the counter trend, B is the last signal was a buy, and then these dots just mean I have received nothing new. In the Russell, I received a sell signal, and on the next day it was confirmed. On the Dow, I received a sell. This is in the counter trend indicator. The counter trend is shorter than short term. The counter trend is saying, I know we're in an up market, but I'm not happy with this. This is the very first indication that things are breaking down. And the breakout catcher. So this is how I fill it out. And then what I look for is another thing called convergence divergence. And I'll show you what that means real quick. And boy, I hope you're still with me. I hope I haven't lost you completely. Let's go back to here, and I'm going to go to my other momentum indicators, and I'm going to get rid of a couple things that I'm not going to talk about. I don't want that one. I don't want that one. And I also want unbalanced volume. For your technical geeks out there, you're probably loving this. For the rest of you, I'm just not sure. This might be too much, but it is what it is. So let me show you what I read here, because now what I'm looking for is momentum. Things have to have momentum. Small waves in the ocean have little momentum. Big waves have big momentum. They'll carry you further. So what I'm looking for is momentum. And I'm just drawing some of my lines here, if you'll bear with me one sec. Because this is what I do every morning on every chart. It takes a lot longer than this, but I'm just showing you. Okay, but we also have some short term. And then on price, these are the prices down here. You can see this was from mid-February. The prices were rising. They kind of got to a top, and they've been definitely falling. So in momentum, what I'm looking for is, are things, the prices are obviously going down recently. We know that. Are my momentum indicators supporting that, or are they arguing, diverging from that, if you will? Well, let's look. The prices are moving down. This is called a moving average convergence divergence indicator. This is just one of the indicators for momentum. Is certainly downtrending. So, but what I want you to notice is, even though when the market was going up right here, okay, let me grab an annotator. Bear with me for one sec here, because I think this will help. So here, the market was, that was a lousy job. Let's do it this way. In this area right here, the market was going up. But my first indication of bearishness, there we go, I can talk, is that, and again, everything to the right we couldn't see yet, why wasn't I more fully invested? This looks like it's a continuation uptrend. I'm getting a divergence here. My momentum is declining. You're not going to continue an up market if your momentum is declining. So we missed some of this up move because I noticed that momentum was declining. This is volume, called on balance volume. And you can see that my volume right now is dropping, meaning the volume is supporting a down move. So that's supportive. But it was a little bit of a divergence here. It was kind of going sideways, even though the market was going up. So the reason I show you this, let me clear out of that, clear all my drawings. And let's see, let's go back to here. And the reason I show you that is when I go back to, whoops, not that one. Let's see here. Bear with me again. Close out some of these charts. And when I go back to here, this is what I want to do. I'm looking for that MACD, and here's my momentum indicators. Is there a divergence? I'm sorry, here, is there a divergence? Well, right now, no, it's supporting bearishness. That's what these mean. OBV, on balance volume, no, there's not a divergence. There was before. If you saw these sheets from 10 days ago, the market was going up, but these were pointing down. That was an indication that something is not right. And then I know this is getting long in the tooth. I look at where it is. It's still above zero, which is a little bit bullish, but it's falling dramatically, so I put a down arrow. That just alerts my eyes that there's more down strength. You don't see a lot of up arrows in here right now. You see down arrows pretty much everywhere. Does that mean the market's going to go down? No. The market could go up for the next 2 days. It could go up 150 points for the next 2 days. But if I have all of this indication that it should be falling, I don't want to get you into a very, very, very short-term up rally that's just going to fake us out. I'm not going to take the time to explain some of these others. This is from LCI Analytics. We looked at that. And so all I'm doing is I'm looking at a number, and this is just part of the analysis. Believe me, this isn't even close to all of it. And I'm trying to get a sense. And I said on the open, I wrote this right when the market was opening, it looks like it's going to be weak. And the market was weak, actually, for the first half of the day. But then at the close of the market, I do another little analysis. The markets closed up, small amount, but they closed up. So this just says, even though it looks weak, it can still go up. The candles were bullish. The volume was not good. It wasn't a lot of volume supporting this small up move. So that looks weak. The condition, weak bullish. On the Dow, it looked bullish. I also make notes of what's happening in the economy that day. At the open, there was a job reports number, and it was below expectations, which is what caused the market to fall in the early part of the day. But the close was neutral to bullish. So on Friday afternoon, my analysis says the close is neutral to bullish. And on Monday morning, when I do my analysis, all over again, I do this every single day of the week, we'll have to look. So the reason I show you all of this, and I think I'm going to stop here because even though I can't see you, I can tell eyes are glazed over. I do this to give me an indication, because when we go to the charts, I can't see Monday yet. It hasn't happened yet. So we take all of this knowledge, if you will, and all of these indicators to give us an idea of, should we be buying things that take advantage of an up market? Should we be buying things that are taking advantage of a down market? And how aggressively should we be building out the portfolio? This is mild bullish, weak, neutral, and mild bullish. I may buy you a one-time S&P or Dow type of an investment, one-time meaning it's not leveraged, just to dip our toes in. If this was real bullish, well, maybe we would go in a little heavier and try to even make more money. I'm going to show you one last thing here, if I can. Bear with me once again. Let's see if you can see this screen. Connect to partner. It's all right. We want to connect. Bam. Okay. What this does, this is just another analysis tool. This happens to be the page I'm on is the ETFs that I trade from around the world. There are 100 different ETFs here representing everything you can imagine around the world. And it stacks the ones that are bullish up top. Remember, I'm looking at volume. I'm looking at, this is the ATM trend decider. This is that RMO. This is the breakout catcher. This is the RMO2. This is the counter trend indicator, candlesticks, RSI we haven't gone over. There's that MACD, which is the moving average convergence divergence. This sheet updates every second that the market is open. So this is just constantly flashing. And what I'm looking for is something like this. This particular security, it's a mortgage-backed security, happens to have a bullish trend decider. It just got shifted from a weak bullish to a more blue, dark bullish. That was an upshift. The breakout catcher is dark blue, which is positive. The RMO is in a weak buy. This would be a strong buy, but there's no counter trend indication. There's no particular candlestick. But what I'm saying is I'm looking for buying opportunities where everything starts to come together. Everything from the other page. The other page that we looked at was looking at the markets. This is looking at individual securities. I can go to, let me show you something else. Here's the leveraged securities that I've been buying and selling a lot over the last 6 months because, quite frankly, the market doesn't know which way it's going to go. And until we're in a full bull market, I won't be buying individual stocks. I'll be buying markets. You see how this says one-time bull? I can buy the Dow by buying that symbol. I can buy the Russell 2000 by buying that symbol. Here's the S&P 500. Here's the NASDAQ. If my indicators were a stronger bullish position, I can buy 2 times bull. Remember, it'll do 2 times what the market, so if the market goes up 1%, this will go up 2%. But you can see that they're all bearish, so I'm not going to buy those. This is 3 times bull. This is, again, only for trading accounts, and this is only intraday. I will never hold these overnight. So if the market went up 1%, this would go up 3%. But if the market went down 1%, this would go down 3%. those are all bearish. Almost everything, except for a couple of little things in here, almost everything is bearish. Okay, now watch this. Here's my 1 time bear, 2 times bear, and 3 times bear. They're all bullish. So even just looking at this piece of analysis, I can just readily see, even without looking at everything else, that this system is thinking that we're going down because these bear market movers, investments, are bullish, and the bull market movers are mostly bearish. So a lot goes into this is all I want to say, and I am going to wrap up now. I hope this was worthwhile for some of you. For any of you that want to do a one-on-one and you have questions and you really want to dig into a piece of this analysis, just call me or better send me an email, and I'm more than happy to do it, because this is a Saturday, so this is all closed, it's all static, but during the week it's all flashing and moving second by second is how quickly it updates. But I wanted you to know that I will conclude by saying this. This is not Slapshot. This is not somebody's opinion. This is, although I guess it is an opinion based on the analysis, this is very analytical. It's very technical. Sometimes I'm going to get a whole page of bearish indications. I'm going to have you out of the market for the most part, and the market's going to go up 100 points. And then I'm going to get a phone call, hey, Bruce, why did we miss this 100-point rally? Well, we missed it because the odds were not stacked in our favor. That's why we missed it. And generally speaking, things change over the longer term, longer being a week, 2 weeks, 4 weeks. The trend analysis is about 90% right over a period of time. I do this every day. It's about 60% right on a day-by-day basis. So 40% of the time we'll miss some of those short moves. But on a longer term, it's almost always right. And I'm going to end where I began. We are not in a good market. We are in, pardon me, because I laughed when one of my clients said, I'm going to smack you if you say a sideways market again. Let me go back to where we started, which was the weekly view of the Dow. I'm sorry, but we are in a sideways market, and this makes it our lives, your life and my life, very difficult. But we're doing the best we can. We have protected you from these downdrafts. We are winning on that marching order. No question about it. What we haven't done is we're not winning on the upside. Hey, make me money. We've made a little bit, but not much. It's hard to make money in a sideways market. Will this change? Yep. When will it change? Your guess is as good as mine. If I want to give you just an off-the-cuff guess, I think it could be weak over the summer because we have this insane election season that we're in, and markets hate uncertainty. They hate uncertainty. They don't care who wins or loses. The markets don't care if it's a Republican. I can't believe Donald Trump is the leader of the Republican Party. But anyway, they don't care if it's a Republican or if it's Democrat. They just want to know, because then they can plan. Right now, nobody knows. All bets are off right now. No one thought Donald Trump would be the GOP's nominee. So all bets are off. So I think it could go down. It might test this a little bit more. I'm always going to protect us in the down. But I think as we get into the fall, I'm not going to be surprised. We will have had a very long sideways market, that we go into a pretty explosive new bull market. And that's when everybody's happy. That's when we make a ton of money, much more than the market. And that's what we're all hoping for. So I apologize for the long video. I know this went way over. I try to keep them to around 30 minutes. I hope for some of you this was interesting. I would love feedback after you get a chance to watch this. Tell me if you liked it or not, because that'll tell me if I should ever do anything like this again. These videos are for you. They're not for me. So please tell me what you want to see, what you want to learn, and I will try to respond as quickly as I can. Thanks again. Have a fabulous rest of your day and fabulous rest of your weekend. I'm sitting in this chair every day the market's open, from way early in the morning until pretty near dinner time. So always shoot me an email or a phone call and you'll get a response very rapidly. Hope you enjoyed this. Thanks. We'll see you next time. Bye-bye.